Welcome to the asset allocation series covering this week's macro regime. My name is Elias Lisberg, and I'm a financial analyst here at Stigner Research. Each month, we try and identify the macro regime for the coming month, determined by our predictions on growth, inflation, and liquidity. And we've just released this month's assessment, which you can find on stignerresearch.com. You can sign up for a 14-day free trial if you haven't subscribed already. Remember, if you like our content, please like and subscribe by clicking below and let us hear your thoughts in the comments. Without further ado, let's get to it. The recent performance of the US economy prompts a reassessment of long-held market sentiments. Ultimately, we consider whether it's time to discard the cautionary and so far costly tales of bears and embrace the potential of a new economic dawn, with productivity allowing for abating inflation and convincing growth. As we venture into February, optimism is intact with various indicators flashing green for the US economy. Growth is not merely inching forward, but appears to be taking confident strides as reflected by the ISM PMI, which we expect to flip above 50. However, this robust uptick warrants a set of concerns, particularly regarding inflation. A base case 0.1% month-over-month print for January translate into a tempered 2.9% year-over-year. But the robustness of economic growth across most gauges, not least with easing financial conditions index and bottoming wage growth, could invoke subsequent inflationary pressures. Liquidity, while we see a rise of 2.3% month-over-month, is not as supportive as January's surge, but it should nevertheless tailwind risk assets further. Ultimately, we see growth up, inflation down, and liquidity up. The Goldilocks regime we've coined gung-ho. The growth outlook remains robust, supported by a solid Atlanta Fed GDP now forecast of 4.2% for Q1 2024, indicative of momentum. ISM manufacturing remains below expansionary levels, but semiconductor shipments reflect strong cyclical demand, and there's been a notable uptick in the ratio of orders to inventories since summer. This improvement coincides with softer financial conditions, buoyed by additional liquidity and the anticipated impact of prospective rate cuts. Most measures point to an ISM manufacturing PMI around 55 by summer. Unequivocal growth, yet the deflationary narrative may see complexities. Robust demand and strong consumption have been allowed by supply normalization, of which further is not guaranteed. The easy disinflation could be offset by potential bottlenecks persisting, not least by further escalation in the Middle East. The ISM services PMIs rose to 53.4 in January, alongside an 11-month high in the prices paid subindex, underscoring the persistence of some inflationary pressures as higher shipping and select commodity prices feed through the services sector. Despite a general downtrend in the ISM services prices paid index, the recent uptick hints of a broader inflationary trend seen in both PCE and CPI metrics. With regards to credit, the recent slews support the outlook for growth and indicates an inflection point, with demand appearing to have bottomed out. From correlation with the slews survey, the wage growth should rebound as credit conditions ease, which could offset the inflation trajectory and Fed confidence. This resurge in wage growth is likely 3 to 4 months from now. Ultimately, the FOMC has a favored period ahead as core inflation components are expected to ease into late 2024, allowing for potential rate cuts in May and/or June, before inflationary pressures reemerge. Consequently, a strategy favoring front-loading and curve steepening looks appealing. Liquidity indicators remain on the rise, with Chair Powell indicating that the Fed's overnight reverse repo doesn't need to be fully depleted to adjust the pace of QT. It seems highly probable that the tapering announcement could come as early as March. The divergent trends between US and Europe are poised to persist, with the US likely to see increased US dollar liquidity and Europe facing further reduction. This suggests a widening rate spread favoring the US dollar, and the rationale for rate cuts appears decidedly stronger in Europe. In response, maintaining short positions in euro-dollar, favoring received positions in the euro curve versus the US dollar, and investing in US duration-sensitive stocks like tech and discretionary align with the forecasted trends for 2024. The correlation between increased US dollar liquidity and equity performance remains strong. The data suggests that liquidity-driven market to continue, supporting further gains in the short to medium term. Our model output suggests a diversified allocation heavily favoring equities, particularly in duration and discretionary sectors. The allocation model is tactically positioned for growth, with a hedge against potential currency volatility and inflation impacts. The strategic allocation output aligns closely with the barbell strategy that tactically overweights DM equities and underweights EM, that is, developed markets versus emerging markets. We concur with the focus on relative safety and quality, in particular US outperformance, while maintaining select exposures to EMs through cyclical currency positions to capture potential gains from FX flows and fluctuations. So, which trades do we like in this environment or the identified regime? We favor long US liquidity-sensitive assets such as tech, consumer discretionary stocks, high beta, high duration. Besides, we like paying in 2s, 5s, 10s in the US dollar curve relative to the Eurozone. Besides, we like the short Euro US dollar position that we've currently got on our books ourselves. Ultimately, long reflation bets in commodity spaces like copper and oil are also bets we ponder on entering. At the end, thanks for tuning in. Make sure to subscribe to stay on top for our next assessment of ups and downs in macro, geopolitics, and asset allocation. See you then.